Cash is king. This is a situation that most people overlook, and we clearly, I think it's a much underexplained, underemphasized area in accounting, because we are so concerned with our understanding of the accruals and of the reporting and of the consistency with SEC and FASB that we sometimes forget that what it's about is reporting out the economic impacts, the economic events of a business. And as we report out those economic events, we should never lose sight of the cash positions of firms. At the end of the day, most valuation of companies is based on their ability to generate cash today and into the future.
But where do we go to get the information we need on the cash strength of a company? The balance sheet and income statements provide a wealth of information. But can we explain changes in cash balances by looking at net income or loss? Can we look at a balance sheet and determine how an investment in equipment was financed? No. The balance sheet and income statements don't directly answer these and other important questions. They are based on accrual accounting and therefore don't provide information about the sources and uses of cash. Is there another financial statement that we could use to get a clearer picture of cash? Yes. For that, you need the statement of cash flows. The statement of cash flows has come to the rescue of many business owners and analysts who want to understand how much cash a business generates. It makes a unique contribution in that it reports revenue actually received and expenses actually paid, while the income statement reports revenue earned and expenses incurred.
The cash flow statement basically shows where the cash is coming from, what the cash is being used for, and I think that that's very valuable. Whereas earnings, again, earnings and net income, and the net income statement can be manipulated somewhat by accountants.
Well, the statement of cash flows, in one sense, is similar to the income statement in that both tell us about changes in balance sheet accounts. But accrual accounting earnings that are shown in the income statement is not what you pay bills with. And so the statement of cash flows gives us a detailed summary of the sources and uses of cash that ultimately we need to be held accountable for in running our business, whether it be paying the debt, whether it be paying dividends, whether it be reinvesting in our company.
And we have a number of examples in our history of companies that were reporting earnings, but they were running out of cash. And the reason was they were buying inventory that wasn't selling. They were selling to customers who weren't paying, and their receivables and inventories were deteriorating, but they were continuing to report profits.
The statement of cash flows has been required of all companies only since 1987. Had this information been available to the creditors and investors of the W.T. Grant Company in the early 1970s, it might have forecast or even helped prevent their financial collapse. After nearly 70 years of continuous operation and regular dividend payments, W.T. Grant and its financial statements looked fairly sound, but the company's cash flows told another story. For years, the company had generated no cash flow from operations, becoming increasingly dependent on external financing. An early warning sign that all ignored. Finally, years of borrowing coupled with rising interest rates resulted in insolvency, and the firm filed for bankruptcy in 1974. 4 months later, its assets were liquidated and it ceased to exist. The W.T. Grant Company went bankrupt because their operations were generating insufficient cash flow over a long period of time. To compensate, they used external financing to generate needed cash. But why did those outside W.T. Grant fail to detect the cash flow problem? Why did bankers continue to loan and investors continue to invest? Because in 1970, companies were not required to publicly report cash flows. In fact, it has taken decades to develop and refine the financial tools that we rely on today. The concept of cash or funds flow has been around since Civil War times. But initially, there was no agreement on the term funds or the purpose of a funds statement. So through the early years of the century, lenders continued to rely on the balance sheet to measure a company's liquidity. After all, the assets on a balance sheet could be held as collateral and liquidated in the event of loan default. The economic crisis of the late 1920s caused lenders to re-examine their dependence on such static measures and focus on the flow of working capital as a measure of liquidity. But users found this too restrictive, and by the 1950s, there was growing support for a statement based on the flow of cash. The inflation of the 1970s sent bankers reeling from loans made not on liquidity, but on overvalued assets. In response, the Securities and Exchange Commission began requiring publicly traded companies to provide a fund statement based on the flow of cash, not working capital. Spurred on by the failure of W.T. Grant and increasingly complicated accrual accounting practices, the Financial Accounting Standards Board, FASB, mandated in 1987 that all firms provide a fund statement based on cash. It had taken over 100 years for the concept of cash flow to become a permanent and requisite part of financial reporting. But the era of solvency reporting had finally arrived. Cash from customers, loans paid off, suppliers paid, equipment purchased, employees paid, dividends paid. A healthy business requires cash to fulfill its business obligations and grow. But how do we report this flow of cash on a financial statement? The Statement of Cash Flows presents 3 cash flow categories. Operating cash flows connected to daily business activities, investing cash flows connected to purchases and sales of long-term assets, and financing cash flows connected to long-term borrowing and to stock. Let's take a closer look at operating cash flows. Cash flows into a company when collected from the sale of core services and products to customers, and from interest or dividends earned on investments. Cash flows out when we pay operating expenses, interest, and taxes. Positive operating cash flows may also be used for investing and financing needs.
In other words, given what it is you do every day in your business, are you able to sell your product for more than its cost and generate enough cash to pay for not only the ongoing operating expense of your business, but to also pay back your debt and invest in assets that help you expand or remain competitive?
The investment category reports cash flowing in from the sale of property, plant, equipment, or from certain types of securities. It also reports cash paid out as a company invests in itself by acquiring equipment, other types of long-term assets, and certain types of securities.
Essentially, this section shows us the changes in long-term assets. It tells us about management's ability and commitment to invest in new technology and new facilities, and may be some sort of signal about their ability to compete going forward. Are they doing what it takes to maintain their competitive business? Are they growing? Are they expanding?
The financing category reports the inflow of cash from issuing long-term debt, such as bonds and notes, or cash sales of the company's stocks. It also reports cash outflows from dividend payments, repayments of long-term debt, and repurchase of a company's own stock.
The financing section essentially shows us changes in long-term liabilities and equity accounts. It tells us about a firm's willingness and ability to pay dividends. It tells us how they're financing these assets. Are they taking on more long-term debt? Are they paying down long-term debt? Again, just shows us something about management's wishes and desires with regard to how they're going to finance those assets.
Are there any significant transactions that occur which don't impact cash? How are they reported?
There are non-cash financing and investing transactions that don't show up at all in the statement of cash flows. For instance, if a firm issues long-term debt or takes on more long-term debt to acquire long-term assets, no cash changes hands per se, and as a result, that is going to be a supplemental disclosure to the statement of cash flows. It won't show up in any of the three sections of the statement of cash flows, but that will be shown separately or disclosed separately as a non-cash investing and financing activity. And typically, those transactions involve both a financing and an investing item.